Hello and welcome to the video on basics of Forex market. In this video, you will get an introduction about the Forex market and you'll also be familiar with the different terms used in Forex market. Let us start. The foreign exchange market, also known as Forex or FX, is the world's most traded market. According to the Bank for International Settlements, global forex trading in 2022 averaged over $7.5 trillion each day. To put that into context, trading on the stock market averages around $553 billion each day, which might seem a lot, but it is just 8% of the total volume that is seen in FX. Here you can see Forex market is traded on an average $7.5 trillion per day, and whereas US stock market, the per day volume is $553 billion. So by this you can get an idea how huge is the Forex market. So what is Forex trading? Forex trading is the buying and selling of global currencies. It's how individuals, businesses, central banks, and governments pay for goods and services in the other economies. Whenever you buy a product in another currency or exchange, cash, or go to holiday, you are trading a forex. However, a significant proportion of forex trades aren't for practical purposes. Speculative FX traders seek to profit from fluctuations in the exchange rates between currencies, speculating on whether which currency will go up or down compared to another one. Now, how forex trading works? Let us understand this concept. Forex is traded in pairs, meaning that when you trade forex, you are exchanging one currency for another. Whenever you are buying euro USD, for example, you are buying euros while selling the US dollar. So if you are trading this forex pair, and if you are going long or buying, whenever you are going long, that means you are buying it, and whenever you are going short, that means you are selling it. So if you are going long on euro USD, that means you are buying this euro and you are selling USD. So if euro strengthens against the dollar, your position will increase in value, and if euro weakens against the dollar, it will decrease in value. Currency markets never decline in absolute terms. For one currency to go up, there will be others weakening against it. All currencies cannot go up at the same time. There is always going to be a winner and a loser. FX traders weigh up whether a currency looks like to strengthen or weaken against another, then they trade the pair accordingly. So if say let's you are bullish on the Japanese yen versus euro dollar versus the dollar, so you can buy Japanese yen and you can sell dollars. So you can trade a particular currency pair, that is JPY USD. So this is how forex works. Now each currency is quoted in a pair as it is written in a three-letter code. Here are the list of some popular currencies and their corresponding code. So US dollar, the code is USD. For euro, the code is EUR. Japanese yen, you have JPY. British pound, you have GGP. Canadian dollar, CAD. Australian dollar, AUD. Swiss franc, CHF. So these are the codes for different currencies and you can trade them in pairs. So when you trade forex, you are buying or selling a currency pair such as euro USD, GBP USD, or USD JPY. Now let's take a closer look at the anatomy of a forex pair. The first currency of this pair is known as the base currency, and the second is known as the quote currency, sometimes also the counter currency. The price of a pair tells you how much of the quote currency you will need to buy a single unit of the base currency. Let's say for a pair of euro USD, so this EUR is your base currency and USD is the quote currency. So and the price of this pair is 1.3010. So that means in absolute terms you are going to pay $1.3010 to buy 1 euro. So this is how you can interpret this pair. Now let's say you are USD is trading at 1.3010. You buy 10,000 euros for $13,010, because if you multiply this one with 10,000 and this will go 4 zeros back. So essentially you are buying 10,000 euros for $13,010. And if euro USD moves to 1.3110, then now you can sell your 10,000 euros for $13,110 by making $100 profit. To buy 10,000 euros, you paid $13,010, and now you are selling the same 10,000 euros for $13,110. So that means dollar has weakened against euro, and now you are having $100 of profit. Let's say if your position dropped to 1.2910, then you paid 1.3010 for 1 euro, and it is now trading at 1.2910. So that means you're booking a loss of $100. So this is how it works pictorially. You bought 1 euro for 1.3010, and if euro rises against USD, you make a profit, and if euro falls against USD, then you make a loss. Similarly, let's take one example of shorting or selling the base. This was the example when you went long on the base, and now this is one example when you will short it. So let's say again Euro USD is trading at 1.3010. This time what you did, you are buying the quote by selling the base. So you bought 13,010 USD by selling 10,000 euros. Now if Euro USD falls, that means euro is weakening against the dollar, you will make a profit over here. And let's say if Euro USD falls to 1.2902, so now you will sell your $12,902 to get your original 10,000 euros back, and as a result you are making a profit of $8. So let's say if you bought one currency pair and you went long, and the price or the overall currency pair strengthens, then you will make a profit in a long position. And if you are shorting it and overall currency pair is weakening, then you will make a profit on your short position. Now let us understand the tick movement, or the ticks in which forex market moves, that is a pip. So pip is a single point of movement in a forex pair. In most FX pairs, a pip is equivalent to a single digit move in the fourth decimal point of a currency's pair's price. Let's say if Euro USD moves from 1.0717 to 1.0718, there is a movement in the fourth decimal, and this movement is known as 1 pip. So if the price changes from this to this, then you can say it has moved up 1 pip. One important exception to the rule is the currency pairs where Japanese yen is the quote currency. So here the pip is equivalent to a single digit move in the second decimal point. So this is an important exception that you should remember. So let's say the quote currency is Japanese yen, and if USD JPY, this is the pair dollar against Japanese yen, it moves from 110.08 to 110.03, then you can say that it is moved down by 5 pips, because the value of Japanese yen is worth comparatively little to other major currencies. That's why for Japanese yen we take the pip for second decimal movement. Otherwise, for all other currencies we take the movement of fourth decimal. Now you can also see the concept of fractional pips. In some currencies you will often see an extra fifth digit after the pip on a forex quote. These are referred to as fractional pips or pipettes. Sometimes they are written in the superscript in smaller font size to differentiate them from the original pips. Now calculating the value of a pip. Let's say a pip is worth 0.0001 or a 0.01% of a single currency unit of the quote currency. That means you have to trade 10,000 units of the base currency to earn 1 unit of the quote for each pip movement. The amount of the base currency you trade is known as the lot size. Now let's say to earn $1 for every pip that Euro USD moves, for example, you have to trade the equivalent of 10,000 euros. Remember that a pip is worth 0.01 or 1% of the base currency when the quote is in. Again, remember the exception you have for yen. If you trade $10,000 of USD JPY, you would earn or lose 100 yen for each pip that USD JPY moves. Now let's see one example. If USD JPY is trading at 110.00, that is equivalent of the $0.91. So if you divide 1 pip divide by 110 into $10,000, you will get this result. Let's take the example for USD JPY. Let's say USD JPY is trading at 110. You use $10,000 to buy 1.1 million worth of JPY. Now let's say USD JPY moves up to 111. Now you can sell your same $10,000 for 1.1 million and an additional 10,000 yen. So that will make you an additional profit of 10,000 yen. Now your buy position earns you 100 yen for every pip of upward movement. Now this is again the same calculation, and similarly if in the other case if USD JPY had fallen to 100 pips, then you would have made a loss of 10,000 yen. Now let's discuss one more important concept, that is of bid and ask prices. Whenever you will see the ladder or in your trading software, whenever you view any general financial market, you will see two listed prices. The price on the left is the bid and the price on the right is ask or offer price. So whenever you sell, you trade at the bid, and whenever you buy, you trade at the ask. So this is a very important concept, and this difference between bid and ask is known as the spread. This is a point 3. So what is the spread? Again, the difference between your bid and ask prices is known as the spread, and it is an important thing when you're trying to calculate your profit and loss from trade. Let me tell you an important use case of the spread. So let's use another example. When Euro USD is trading at 1.259 and it might have a bid of 1.257 and the ask of 1.260. So to buy Euro USD, you would open your position. Let's say you're going long and so you're trading at an ask of 1.260. Now you would need Euro USD bid price to move up above 1.260 to make you a profit. Otherwise, you will have to break even your position. Now, if Euro USD moves up by 2 pips from 1.259 to 1.261 and still the bid is at 1.259 and now you want to get out of your position that you entered at 1.259, because the market price of Euro USD has moved up by 2 pips but the bid is still at 1.259, then you will have to sell at zero profit or zero loss. So this was about spreads, and now let us discuss leverage in Forex. So leverage is a tool used by traders that enables them to control a large amount of capital by putting down a much smaller amount. Unlike traditional investing, where you must tie up the full value of your position, with leverage trading you have to put up a smaller position known as margin. In case of 50 to 1 leverage, for example, you can use $1 to control the position of $50. So leverage has opened forex markets for many retail traders who cannot allocate large capitals to their positions. However, leverage can also magnify your profits and also can give you very large losses. So let us see one example of leverage. Let's say you are having a 50 to 1 leverage or a 2% leverage. By using this example, if you place $100,000 of USD Canadian dollar trade with 50 to 1 leverage, that means your margin requirement is only 2%. So you can trade size of $100,000 by putting only $2,000 as the initial capital requirement. Same thing if you want to trade $10,000, then since you are paying using 50 to 1 leverage and you have to pay only 2% of this amount, then you can only trade with $200. So this is the required margin if you're using leverage. I hope you're clear with all the concepts discussed in the video. Thank you for watching. Now let's move to the next one.